So how does a company whose entire business model, like historically relies completely on people getting mortgages, manage to post record profits right now?
Right. I mean, especially during the worst mortgage freeze we've seen in a generation.
Exactly. I mean, think about the environment you and I are in right now, 30-year fixed mortgage rates just climbed back up to 6.6% in the second quarter.
Yeah, it's rough. The housing market is just effectively trapped in amber at this point.
It really is. You have millions of homeowners sitting comfortably, or, well, maybe uncomfortably, in their houses, but they are entirely locked in by those golden 3% pandemic-era mortgage rates.
Right. They aren't moving. Why would you?
Exactly. Why would you give that up? So mortgage originations are just severely depressed. And by all traditional logic, a major credit bureau, as a company literally synonymous with the phrase pulling your credit for a loan, should be flashing massive warning signs.
Oh, absolutely. We should be seeing missed targets across the board, lowered guidance, and a stock price under severe pressure.
But instead, this company comes out and reports they're expanding their margins, aggressively growing revenue, and essentially just printing cash.
It's wild. It forces a complete reevaluation of how we even categorize these legacy financial institutions.
Welcome to this Talk Tickers Deep Dive. Today we are looking at the official Q2 2026 earnings presentation and the raw call transcript for Equifax.
Ticker symbol EFX for those following along.
Right, EFX. Now, for those of you who follow our usual format, you know our goal is to take these massive jargon-filled Wall Street earnings calls, strip away all that corporate speak, and deliver the data-forward, actionable takeaways for retail investors.
And normally we try to do that in under 5 minutes.
We do. We usually try to be super concise and hit the core thesis quickly, but today, well, we are setting the clock aside.
Yeah, we have to. The strategic pivots detailed in this specific Equifax transcript are just too big to gloss over.
Exactly. The way they are utilizing artificial intelligence, and not just as some, flashy buzzword, but as a structural sledgehammer to their cost base. Yeah. And their aggressive international expansion, it all demands a much deeper look.
Definitely. We are going to explore exactly how management is completely decoupling their growth from the housing market.
The contrast between the macroeconomic headwind and their microeconomic execution is just stark. I mean, it is a phenomenal case study in defensive business strategy turning into offensive market capture.
It really is. We have to look at how they are basically replacing legacy zero-margin products with highly profitable proprietary data streams.
So let's start with the hard numbers to ground this conversation for you guys. The top-line revenue figure came in at $1.7 billion for the second quarter.
That's a huge number.
It is. That is an 11% increase on a reported basis year over year. And management also noted it was up 10% in constant currency.
Which is a super important detail to catch.
Right. And just to put this into perspective, against Wall Street's expectations, that $1.7 billion beat their own April guidance by $5 million.
So they are growing at double digits while their core historical market is practically asleep.
Exactly. And you mentioned that constant currency metric is crucial. Why is that so important here?
Well, it's crucial for understanding the raw momentum of the underlying business. Equifax is a massive global operation.
Right. They are everywhere.
Yeah. So when they generate revenue in the UK, Australia, or Latin America, they eventually have to convert those pounds, dollars, and pesos back into US dollars for their quarterly reporting.
Got it. So exchange rates play a huge role.
Exactly. If the US dollar happens to be particularly strong during that 3-month window, it mathematically shrinks the value of that international revenue on paper.
Even if they actually sold more products overseas in reality.
Exactly. Even if volume is up. So by reporting a 10% growth in constant currency, management is stripping away the noise of the foreign exchange market.
Oh, that makes a lot of sense.
Yeah, they are telling investors that the actual volume of data they are selling, like the core engine of the enterprise, is expanding robustly, regardless of global currency fluctuations.
Right. It shows the fundamental demand for their services isn't masking a slowdown behind favorable exchange rates.
Precisely.
But, top-line growth is only half the equation here. I mean, a company can aggressively grow revenue by slashing prices and spending a fortune on marketing.
Oh, we see that all the time.
Right. But if that money doesn't actually make it to the bottom line, it's a completely hollow victory for shareholders.
100%.
So looking at profitability, their adjusted earnings per share, the EPS, came in at $2.25.
Which is fantastic.
Yeah, that is a 13% increase year over year, and it beat their previous guidance by 5 cents a share.
And there was a specific adjustment in there, right?
Yes, good catch. I noticed they had to make a specific adjustment this quarter for a $40 million charge net of insurance proceeds related to a past legal settlement over some coding issue.
Ah, right. Those legacy legal issues.
Yeah, so we stripped that one-time penalty out to see the real recurring profit power of the business, and it is undeniably strong.
The strength of that bottom line is where the real narrative of this quarter lives, honestly. And it brings us to what is probably the most critical profitability metric in the entire transcript.
Oh, I know exactly which one you're talking about.
Yeah, it's a metric that fundamentally alters the valuation model for Equifax. We need to look really closely at their ex-FICO EBITDA margin.
Yes, I want to pause on that because this is a metric that trips up a lot of retail investors who might be, newer to the financial data sector.
It can be super confusing at first glance.
So their core cash profit, the EBITDA, or earnings before interest, taxes, depreciation, and amortization, hit a range of 34.6% to 35%.
Which is massive.
It really is. That is a 120 basis point expansion year over year.
Just expanding your profit margins by 1.2% across a multi-billion-dollar revenue base is incredible.
Especially when inflation is still pressuring corporate America's labor and operational costs, right?
Yeah.
It's a monumental operational achievement.
Absolutely. It means roughly 35 cents of every dollar they bring in is staying in the company as pure operational cash flow.
Right, but it's that ex-FICO qualifier that is so fascinating to me. Equifax is explicitly telling Wall Street to judge their profitability without including FICO scores.
It is a really unique structural quirk of the credit reporting industry, and understanding it is pretty much essential to understanding Equifax's current strategy.
So break that down for us. Why exclude FICO?
Well, Equifax, alongside Experian and TransUnion, they build the massive databases of consumer credit history, right? They hold the raw data.
The actual payment histories and all that.
Exactly. But historically, they did not create the mathematical algorithm that scores that data for mortgage lenders.
Right. That algorithm was created by the Fair Isaac Corporation, universally known as FICO.
Right. And for decades, the industry standard has been that when a bank pulls a credit report to underwrite a mortgage, they legally require a FICO score attached to it.
So Equifax basically facilitates that transaction. They pull their raw data, run it through the FICO algorithm, and sell the packaged result to the bank.
Yes, but Equifax essentially acts as a toll booth that isn't allowed to keep the toll. They're just passing the money through.
Wow, so they collect the fee from the lender and hand it directly to Fair Isaac.
That captures the dynamic perfectly. The transcript explicitly details that FICO mortgage scores represent approximately 50% of Equifax's U.S. Information Solutions mortgage revenue.
50%, that's huge.
Yeah, and almost 5% of total Equifax revenue globally. Yet, Equifax makes zero margin on the sale of those FICO scores.
Zero margin. That is insane. It's just a contractual pass-through cost.
Exactly. So when Equifax highlights their ex-FICO EBITDA margin, they are intentionally isolating their own proprietary value-added products.
Right. They're basically saying, if you remove this massive chunk of revenue that we are forced by industry convention to process at zero profit, look at how incredibly efficient and profitable our internal operations actually are.
Which perfectly sets up their broader strategy right now.
Because if you have a zero margin anchor tied to 5% of your global revenue and your traditional growth engine mortgages is just completely stalled out by 6.6% interest rates, you have to engineer a way out of the trap.
You really do. You can't just wait around for the Federal Reserve to cut rates. You have to manufacture your own growth.
And based on this transcript, Equifax has launched a highly aggressive, multi-pronged offset strategy.
They really have. The first major offensive is a direct, calculated attack on that FICO monopoly.
Right. They are pushing their own proprietary scoring model, VantageScore.
The VantageScore initiative is just a textbook example of leveraging regulatory shifts to disrupt an entrenched incumbent.
So where did VantageScore even come from?
Well, it was actually created years ago as a joint venture by the three major credit bureaus, specifically to break their reliance on FICO.
Oh, so they all teamed up to build a competitor.
Exactly. It utilizes their own proprietary machine learning algorithms to score their own data. And most importantly, they actually capture the profit margin when a VantageScore is sold.
But for years, it struggled to gain any real traction in the mortgage space, right?
Yeah, it really struggled because Fannie Mae and Freddie Mac, the government-sponsored enterprises that buy and back the vast majority of U.S. mortgages, mandated the use of FICO scores.
Right. If Fannie and Freddie won't buy a mortgage unless it has a FICO score attached, then every single originator in the country is forced to buy FICO scores.
Regardless of whether a better or cheaper alternative exists, It was an ironclad regulatory monopoly.
But that monopoly was broken last July.
Yes, it was. The Federal Housing Finance Agency, the FHFA, issued a mandate allowing mortgage originators to choose between VantageScore and FICO for loans destined for Fannie and Freddie.
Which is a game changer. This opened the door, and Equifax immediately kicked it wide open using, honestly, the most aggressive tool in corporate strategy, predatory pricing.
Oh, absolutely. During the Q2 call, management confirmed they are pushing VantageScore to lenders at a highly disruptive $1 price point.
A single dollar.
A single dollar. And they have committed to holding that price through the end of 2027.
I mean, when you look at the thousands of dollars involved in closing costs and underwriting fees for a standard mortgage, offering the core credit score for $1 is basically giving the intellectual property away for free.
It's a pure market penetration strategy. They are utilizing a massive loss leader to force behavioral change across an entire industry.
And Equifax has calculated that the behavioral change is worth that upfront subsidy, right?
Definitely. They estimate that the industry-wide shift from FICO to VantageScore represents a $1 billion annual cost savings opportunity for mortgage originators and ultimately consumers.
Wow, $1 billion. When you wave $1 billion in aggregate savings in front of the banking sector, they start to pay attention really quickly.
Oh yeah, and the transcript shows this traction is accelerating rapidly. In the second quarter alone, VantageScore volumes tripled compared to Q1, hitting 2.2 million transactions.
That's a massive quarter-over-quarter growth.
It really is. They currently have over 1,200 mortgage lenders actively pulling a free VantageScore alongside their paid FICO scores.
Just to test their internal systems, right? Calibrate their risk models and get comfortable with the new algorithm.
Exactly. But testing is one thing. Completely ripping out your legacy software architecture and migrating your primary underwriting pipeline to a new standard is a massive logistical headache for a bank.
Right. There's always huge friction in enterprise software migration. However, Equifax noted they already have about 100 lenders, mostly smaller non-GSE originators and those issuing home equity lines of credit, who have fully migrated to utilizing VantageScore exclusively.
Which tells me the software integration friction is surmountable.
Yeah, and once those larger 1,200 lenders finish their shadow testing and finally flip the switch, that $1 revenue stream, while seemingly small, becomes infinitely sticky.
And vastly more profitable than the zero-margin FICO pass-through.
Absolutely. So how is FICO responding to this? I have to imagine they aren't just taking this lying down.
Oh, they definitely aren't. The CEO of Equifax, Mark Begor, addressed the competitive friction directly during the Q&A segment, and it provided a fascinating look at how FICO is trying to defend its turf.
What did he say?
Well, an analyst brought up the fact that FICO is attempting to alter its pricing model to compete with this $1 VantageScore threat.
Okay, how so?
FICO is proposing a model where they charge a low upfront fee to pull the score, but then they attach a massive success fee, reportedly around $66, that is charged to the consumer at the closing table if the mortgage actually funds.
Wait, really? That feels incredibly precarious from a compliance standpoint.
It really does.
I mean, trying to hide the cost of a credit score in the final closing documents as a massive success fee seems like a desperate way to protect their margins while pretending to compete on the initial cost.
Begor completely dismissed FICO's strategy, and he actually used federal law to do it.
Oh, interesting. What law did he cite?
He pointed to RESPA, the Real Estate Settlement Procedures Act.
RESPA.
Yeah, RESPA is a consumer protection statute designed to eliminate kickbacks and ensure transparency in real estate settlement costs.
Right. You can't just invent junk fees at the closing table.
Exactly. So Begor argued that under RESPA, trying to justify charging a consumer $66 for a credit score at the closing table, when the exact same function could have been achieved with a $1 VantageScore up front, simply will not survive regulatory scrutiny.
That makes total sense. Mortgage originators have a strict legal obligation to treat consumers fairly regarding the fees they pass along.
Begor's stance was highly confident. He basically said, FICO can attempt whatever complex pricing gymnastics they want, but the regulatory environment and basic commercial logic heavily favor the transparent $1 alternative.
He is basically daring the major banks to try and explain a $66 line item to federal regulators when a cheaper, federally approved option was sitting right there.
It's a brilliant cornering maneuver by Equifax.
It really is. But, as fascinating as this Vantage score war is, it is ultimately a battle over the legacy credit report.
Right. It's still just backward-looking credit data.
Exactly. If we want to understand how Equifax is genuinely reinventing itself and generating this massive revenue resilience, we really have to look at their workforce solutions division.
EWS.
Right, EWS, and specifically what they call twin data.
Workforce Solutions is honestly the crown jewel of the modern Equifax enterprise.
I totally agree.
To understand its power, you kind of have to understand the fundamental limitation of a traditional credit score.
Okay, break that down for us.
Well, a standard credit report, whether it's FICO or even VantageScore, is inherently backward-looking.
Right, it looks at the past.
Exactly. It tells a lender if you missed a credit card payment 3 years ago, or if you paid off an auto loan last month. It measures your historical willingness to pay your debts.
But it tells the lender absolutely nothing about your current ability to pay a new debt.
Precisely.
I've always thought of a traditional credit report as like a shadow. It gives the bank a rough two-dimensional outline of your financial history. It's useful, but it lacks detail.
That's a great analogy.
And what Equifax is doing with twin data is upgrading that shadow to a high-definition, real-time photograph. They are combining the traditional credit file with proprietary real-time verification of an applicant's current employment status and exact income.
They call it the twin indicator.
Right. They aren't just telling the bank you have a 720 credit score. They're telling the bank you currently work at a specific logistics company making exactly $85,000 a year and your last paycheck cleared on Friday.
And from a risk management perspective, that level of granular real-time visibility is just transformative.
I can imagine.
Think about it. If a regional bank is trying to decide whether to approve a $30,000 auto loan in a shaky macroeconomic environment, knowing the applicant hasn't defaulted in the past is helpful.
Sure, it's a good baseline.
But knowing definitively that the applicant is employed today and has the cash flow to cover the monthly payment fundamentally de-risks the loan.
Right. Lenders can approve more marginal candidates, capture more interest revenue, and lower their default rates simultaneously.
It's a win-win for the lender.
But the key here isn't just that the data is useful, it's that Equifax has effectively monopolized the source of the data.
Yes, that is the competitive moat.
Right. Wait, so they aren't just scraping the internet for this stuff?
No, not at all. They built a direct pipeline into the payroll systems of American businesses.
That is wild.
Through EWS, they have amassed a database of 124 million current active employment records and 217 million total records, which is growing at 10% year over year.
Given there are roughly 250 million income-producing individuals in the U.S., they have near ubiquitous coverage.
It is a massive, incredibly deep data moat. A nimble tech startup cannot simply replicate direct integrations with thousands of corporate payroll departments overnight.
No way. And that data moat is exactly what is driving their explosive growth in the government sector, which I found to be one of the most compelling sections of the entire Q2 presentation.
The government numbers were staggering.
Over just the last 4 months, the Workforce Solutions Division secured $300 million in contracts with state and federal agencies.
And the breakdown of that $300 million is what really caught my eye.
Yeah, it's not just inertia, right? It's not just states rubber stamping old agreements.
Exactly. Of that total, $200 million represents renewals and winbacks from competitors, but a full $100 million is brand new annual contract value.
That is fresh revenue entering the ecosystem. So why is the government suddenly writing massive checks for real-time income verification?
It all traces back to a major piece of federal legislation referred to as OB3, which was signed into law last July.
OB3, okay. What does that do?
This legislation mandates significantly tighter requirements for the accuracy and frequency of income validation across federal social safety net programs, most notably Medicaid and SNAP.
SNAP being the Supplemental Nutrition Assistance Program.
Right. The federal government is aggressively cracking down on improper payments and systemic fraud. State governments are the entities that actually administer these programs locally, and they are now under strict federal mandates to ensure that every individual receiving benefits legitimately qualifies based on their real-time income.
Man, in the past, this was an administrative nightmare. You had state caseworkers manually reviewing physical pay stubs submitted by applicants or, relying on outdated state tax data.
It was incredibly slow.
Slow, incredibly labor-intensive, and highly susceptible to both innocent errors and intentional fraud.
But with Equifax's twin data architecture, A state Medicaid office can simply ping the EWS database via an API and instantly verify the applicant's current employment and exact income directly from the employer's payroll system.
It takes a process that used to require hours of manual labor and reduces it to a millisecond automated query.
It fundamentally hardens the integrity of the social safety net.
The efficiency gains for state governments are just undeniable.
Right.
Mark Begor highlighted a really specific example during the call, didn't he?
Yeah, he mentioned an almost $60 million annual contract win-back supporting a state delivering Centers for Medicare and Medicaid Services benefits.
CMS benefits, right.
This particular state had actually previously tried to migrate away from Equifax to utilize cheaper alternative methods.
Like what? Relying on self-reported consumer data?
Exactly, or delayed state wage databases. But the experiment completely failed.
I bet. The error rates must have been through the roof.
The error rates and administrative friction were way too high. The sheer accuracy and instantaneous nature of Equifax's direct from employer data proved indispensable.
So the state returned and signed a massive contract.
Yes, they did.
You know, when a client tries to leave for a cheaper alternative and is effectively forced to come back because your product is structurally superior, that is the ultimate validation of a wide economic moat.
It really is. And the runway here is just staggering.
Equifax's government sector revenue is currently an $800 million annual business. But management explicitly noted that the total addressable market, the TAM just within the government space, is $5 billion.
They have only penetrated a fraction of the available market.
And that's before we even talk about how twin data is being deployed back into the private sector.
Right. In the private consumer lending space, the EWS Diversified Markets Division saw high double-digit growth across auto lending, credit cards, and broader consumer finance.
And Equifax is playing a very smart long game here, right?
Extremely smart. They are currently providing the Twin Indicator Data Bundle for free to lenders in certain verticals on a trial basis.
I love this tactic. It's the classic software as a service playbook. You give them the premium feature for free during the pilot phase.
Exactly. They integrate the real-time income data into their automated underwriting algorithms. They immediately see their loan approval rates go up while their default rates go down, and suddenly their risk models become completely dependent on that data feed.
Yep, and once the trial ends, there is zero chance the bank's chief risk officer allows them to revert back to just using a basic, backward-looking credit score.
The revenue stream becomes incredibly sticky. It creates total vendor lock-in.
And this dynamic Vantage score attacking the zero-margin FICO problem, and twin data driving massive proprietary growth in both government and private sectors explains how Equifax is growing top-line revenue despite the frozen mortgage market.
They are simply extracting significantly more value per transaction in other sectors by offering vastly superior, irreplicable data products.
Okay, so that perfectly explains the revenue resilience. But we have to return to that 120 basis point margin expansion we talked about earlier.
Mm-hmm. Right, because selling more data products helps, but to structurally widen your profit margins by that magnitude across a multi-billion-dollar legacy enterprise requires something much deeper than just a good sales quarter.
Exactly. You have to fundamentally alter how the company operates. And this brings us to what I think is the most consequential revelation of the entire earnings transcript.
The true engine behind the margin miracle.
Right. Management attributed this massive profitability leap almost entirely to artificial intelligence.
Which is a bold claim.
It is.
Yeah.
And look, I know you guys listening are inherently skeptical of this. In 2026, every single CEO slaps the word AI on their earnings call to generate algorithmic buzz and pump the stock price.
It's usually just a vague promise of future synergies.
Exactly. But what Equifax detailed here was not a vague promise. It was a highly specific, quantified, and aggressive operational overhaul.
The contract between companies merely talking about AI and companies actually deploying it at the core operational level is basically becoming the defining metric of corporate success this decade.
And Equifax falls squarely into the latter category.
You really do. Management dropped a staggering metric on this call. Back in February, they projected that their run rate cost savings from deploying artificial intelligence across the business would be $75 million.
Right.
Fast forward just a few months to this Q2 call, and they have literally doubled that projection.
Doubled it.
Yes, they now anticipate run rate cost savings of $150 million from 2026 to 2028.
Doubling a massive cost-saving projection in less than 6 months is highly unusual in corporate finance.
It's almost unheard of.
It implies that whatever internal pilot programs they were running vastly exceeded their own optimistic expectations. The technology is scaling faster and generating efficiencies quicker than they modeled.
Absolutely.
So where exactly is this $150 million coming from? Because you don't save that kind of money by just giving your marketing team a ChatGPT subscription, you know?
No, you definitely don't. Bigor provided a very granular breakdown of where this AI is being aimed, and it is aimed squarely at their largest operational expenses.
Okay, give us a breakdown.
He noted that Equifax has approximately $2 billion in gross labor spending, which accounts for roughly 40% of their total gross spend.
So labor is a huge chunk of their overhead.
Massive. And of that $2 billion labor pool, about 60% is concentrated within their global operations and technology organizations.
So that specific segment is ground zero for their AI automation strategy. We are talking about automating the call centers, the data processing hubs, and the software engineering teams.
Exactly. In their customer-facing operations, they are rapidly deploying advanced conversational AI agents across their call centers globally.
And this isn't the clunky, frustrating phone tree technology of 10 years ago, right?
Oh, not at all. These agents are handling complex customer authentication protocols and achieving massive lifts in first call resolution rates.
So when a consumer calls Equifax to dispute a fraudulent mark on their credit report, they are increasingly interacting with an autonomous AI, not a human representative.
Right. Furthermore, in the back office, AI is completely overhauling their document processing. A credit bureau ingests millions of pages of paper and digital documents, daily disputes, legal filings, identification proofs.
And now AI vision models and natural language processors are managing that flow.
Automatically extracting the relevant data, cross-referencing it with the database, and processing the disputes in a fraction of the time it took human data entry clerks.
It is a complete digitization of the corporate assembly line. The friction of manual human labor is literally being engineered out of the system.
It really is. And they are applying the same aggressive automation to their technology teams as well.
The technology deployment is arguably more profound, honestly. Bigor stated explicitly that they are utilizing AI for core software development, IT operations, cybersecurity threat detection, and cloud cost optimization.
They have deployed advanced AI coding assistants, effectively internal co-pilots, across all their engineering teams.
So large portions of their routine code generation, bug testing, and system maintenance are now being executed by AI agents.
Yes. The human software engineers have essentially transitioned from writing every single line of code to acting more in a quality control and architectural capacity, overseeing the output of the AI.
They have moved way beyond experimental pilots. Autonomous agents are now operating core internal technological processes.
But there's a massive structural prerequisite for this that I really want to highlight, because it explains why Equifax can do this while other 100-year-old financial institutions are struggling.
Oh, this is a great point. John Gamble, the CFO, made a vital point about their infrastructure.
Right. Equifax spent the last 5 years and literally billions of dollars executing a grueling, comprehensive migration to the public cloud.
They completely rebuilt their data architecture.
Exactly. Because they are now operating on a modern, cloud-native standard data fabric. Their data is universally organized, tagged, and accessible.
So when they deploy a new AI agent into their environment, that agent can instantly access, understand, and manipulate the data across the entire enterprise.
Precisely. You cannot do this if you are a legacy bank running your operations on a fragmented series of on-premise mainframes built in the 1980s.
No, you definitely can't just plug a modern large language model into a COBOL mainframe and expect it to automatically resolve complex credit disputes.
That structural reality is the hidden moat here. The painful multi-year cloud migration was the foundation. The current AI deployment is the skyscraper being rapidly constructed on top of it.
Equifax endured the pain of modernization early, and now they're reaping the exponential rewards of agility.
And they aren't just using AI to slash back office costs. They are embedding it directly into the products they sell to generate new revenue.
Yeah, in just the first half of the year, they launched 54 new products that feature native AI capabilities directly embedded within their architecture.
This rapid innovation cycle contributed to a highly impressive 16% new product vitality index.
I love that vitality index metric. It measures the percentage of a company's total revenue that is derived from products introduced within the last 3 years.
Right, so hitting 16% tells me they aren't just resting on their laurels, passively collecting tolls on their legacy data.
Almost a fifth of their entire revenue stream is coming from solutions that didn't even exist a few years ago. They're forcing themselves to innovate.
And one of those new AI products really stood out in the transcript, the Ignite AI Advisor.
The Ignite AI advisor is a perfect example of moving up the value chain.
Imagine you are the chief risk officer at a mid-sized regional bank or, a specialized auto lender. You have access to Equifax data, but you don't necessarily have a massive, expensive internal team of data scientists to analyze it deeply.
The Ignite AI advisor essentially acts as an outsourced on-demand data science team.
It allows clients to interact with Equifax's massive data lakes using natural language queries.
So instead of writing complex SQL code or waiting weeks for a custom report, the client can just type a question like, show me a geographic breakdown of where my existing credit card customers are successfully securing auto loans from my competitors.
Or run a stress test on my current portfolio's payoff speeds against the industry average, assuming a 0.5% rise in unemployment.
And the AI agent instantly understands the intent, queries the massive Equifax standard data fabric, dynamically generates the charts and graphs, and delivers a fully formed, actionable analysis.
It completely democratizes enterprise-grade data analytics.
By providing the analytical engine alongside the raw data, Equifax transforms its relationship with the client. They cease being just a commoditized data vendor and become an indispensable strategic partner embedded directly in the client's decision-making process.
This combination slashing internal labor costs through back-office automation, accelerating software development with AI coders, and selling high-margin AI-driven analytical tools is the mechanical reality driving that 120 basis point margin expansion.
They are fundamentally processing more data, building more products, and delivering more insights with significantly less incremental human labor.
It is the absolute definition of operating leverage.
It really is. And it paints a cohesive picture of why they comprehensively beat expectations despite the macro environment. We have the VantageScore offensive displacing the zero-margin FICO pass-through.
The twin data moat capturing massive, sticky government contracts.
And the AI margin miracle permanently lowering their cost base. But as we know, the stock market is inherently forward-looking.
Right. The market doesn't care what you achieved yesterday. It only cares about your trajectory for tomorrow.
So we need to look at management's guidance and capital allocation strategy.
Equifax laid out a highly confident, clearly defined roadmap for the remainder of the year. Looking at the short term, for the upcoming third quarter of 2026, they are guiding for revenue between $1.68 billion and $1.71 billion.
If they hit the midpoint of that range, it represents nearly 10% reported revenue growth year over year.
So they are maintaining that near double-digit velocity.
Yes, and they project Q3 EPS to land between $2.15 and $2.25, which is roughly an 8% increase.
More importantly, they explicitly guided that those crucial ex-FICO EBITDA margins will remain incredibly robust, staying in that 34.6% to 35% range.
Which represents over 90 basis points of expansion compared to the prior year.
They are signaling that the margin improvements are structural and sustainable, not just some one-time quarterly blip.
But the most significant takeaway from the guidance section wasn't the Q3 revenue target. It was their full-year cash flow projections and what they actually intend to do with that cash.
CFO John Gamble reiterated their expectation to generate over $1 billion in free cash flow for the full year 2026.
Furthermore, he noted they expect a cash conversion rate of at least 100%.
And for our listeners, the cash conversion rate is a truly critical metric of financial health.
It measures how efficiently a company translates its accounting profits, which can be manipulated by depreciation and non-cash charges, into actual liquid cash deposited in the bank.
A rate of 100% or more is exceptional. It proves their earnings quality is pristine, the profits are real, liquid, and immediately available for deployment.
Gamble outlined that with full-year EBITDA expected to hit roughly $2.1 billion, this financial engine generates a massive war chest of approximately $1.5 billion in available capital for 2026 alone.
All while maintaining a very conservative debt leverage ratio of under 3 times EBITDA.
That $1.5 billion war chest is the ultimate strategic weapon. When a company generates that much excess cash, the paramount question becomes capital allocation.
And Equifax made a major announcement regarding exactly how they plan to deploy a significant portion of that capital.
Yes, they announced a definitive agreement to acquire Circulo de Credito for an enterprise value of $750 million.
Half of their available annual capital deployed in a single transaction.
A $750 million acquisition. Who is Circulo de Credito and why is Equifax writing a check that large?
Well, Circulo de Credito is the fastest growing credit bureau in Mexico. And this acquisition represents a brilliantly targeted expansion into a structurally different hypergrowth market.
Right, because the macroeconomic landscape in Mexico is fundamentally different from the U.S. or Western Europe.
It really is. Mexico has a massive, rapidly growing population, but a staggering portion of that population operates entirely outside the traditional banking system.
Nearly 33 million Mexicans are engaged in informal employment gig economy workers, unregistered micro-businesses, street vendors.
And traditional credit bureaus, which rely on W-2s, standard pay stubs, and established bank accounts, are completely blind to this demographic.
You cannot underwrite a loan for someone who has no formal financial footprint.
And if you can't underwrite them, they can't access credit to grow their business or buy a home. It's a massive unserved market.
Precisely. Circulo de Credito recognized this gap and built a tremendously successful business by aggressively pioneering alternative data aggregation.
Instead of relying on traditional banking feeds, Circulo ingests data from gig economy platforms, utility payments, telecommunications billing, and other non-traditional transaction histories.
By analyzing these alternative data streams, they can accurately model the creditworthiness of the unbanked population.
Through this strategy, Circulo has amassed an incredible database of 2 billion trade lines covering over 80 million validated consumer identities in Mexico.
This unique capability has made them the indispensable data backbone for the booming Mexican fintech sector, which is desperately trying to lend to this newly scorable demographic.
Over 40% of Circulo's revenue growth is driven by these fintech customers, and that specific segment is compounding at over 50% annually.
The growth metrics are explosive.
They are phenomenal. Between 2023 and 2025, Circulo's compound annual revenue growth rate was 23%.
And for the 12 months ending in June of 2026, revenue surged by 31%.
Furthermore, they aren't burning cash to achieve this growth. They operate with very robust mid-40s EBITDA margins.
Okay, the asset itself sounds fantastic. It's a high-growth monopoly on alternative data in a massive underpenetrated market. But I have to push back hard on the valuation and the execution risk here.
Fair enough.
$750 million is a massive premium. John Gamble defended the price by pointing out they bought it at an 11.7x EBITDA multiple based on expected 2026 numbers, and he claimed that once you factor in the run rate synergies, that multiple drops to a highly attractive 9.4x.
Right, the synergy argument.
But wait, a 9.4x multiple assumes they actually achieve those synergies flawlessly. What happens if integrating a fast-moving alternative data Mexican fintech into a massive U.S. corporate cloud architecture turns into a bureaucratic nightmare?
Cross-border tech integrations are notoriously difficult, I agree.
If those cost savings don't materialize, they vastly overpaid.
It is a valid and necessary skepticism. M&A execution risk is always the primary threat to capital allocation. However, Equifax's track record provides significant reassurance here.
Why do you say that?
The synergies Gamble is referring to aren't vague corporate buzzwords, because Equifax has already completed their own grueling migration to a unified global cloud-native architecture. Integrating new acquisitions is vastly simpler than it was a decade ago.
Ah, right. They don't have to merge disparate ancient mainframes.
Exactly. They simply ingest Circulo's data into the existing Equifax global data fabric. Furthermore, Equifax has executed this exact playbook successfully in Latin America recently.
That's right. They acquired Boa Vista in Brazil and Data Credito in the Dominican Republic.
And they successfully migrated both onto the Equifax cloud and expanded their margins. They have a proven, repeatable blueprint for international integration.
Paying a 9.4x post-synergy multiple for an asset organically growing top-line revenue at 30% in a financial data sector where Equifax itself trades at a significantly higher multiple actually is a highly disciplined use of capital.
That structural advantage of the unified cloud data fabric keeps appearing at every turn, whether it's deploying AI or digesting international acquisitions. It is the hidden multiplier on their execution.
But they aren't spending the entire $1.5 billion war chest on M&A. Management went out of their way to emphasize that returning capital directly to shareholders remains a co-equal priority.
In just the first 6 months of the year, Equifax executed aggressive stock buybacks, repurchasing 3.1 million shares for a total of $560 million.
To contextualize that scale, they retired roughly 2.5% of their total outstanding shares from the open market in just 2 quarters.
They are systematically shrinking the supply of their stock.
Additionally, they paid out $66 million in dividends, having previously raised their dividend payout by 12% earlier in the year.
If you look at the trailing 12 months, Equifax has returned over $1.6 billion directly to shareholders through buybacks and dividends.
That equates to returning 100% of their operating capital. They're generating massive cash, using a portion to buy hyper-growth assets like Circulo, and immediately handing the rest back to the owners of the business.
Which brings us to the ultimate question for the retail investor listening to this deep dive.
We have waded through the macroeconomic headwinds, the margin expansions, the AI deployment strategies, and the intricacies of Mexican gig economy credit scoring. We have to synthesize this into an actionable thesis for you guys.
Based on the totality of this transcript, is the Equifax Q2 2026 earnings report a bullish or a bearish signal for the stock?
What's your take?
When you look comprehensively at the data, the strategic execution, and the macro-level resilience demonstrated in this call, I take a definitive stance. This is an overwhelmingly bullish signal.
I find myself drawing the exact same conclusion, and it really comes down to the complete destruction of the bear thesis.
For the last 2 years, short sellers and market skeptics looked at Equifax and articulated a very simple, seemingly logical narrative.
This is fundamentally a mortgage-dependent data company operating in the most restrictive high-interest rate environment in 20 years. With rates pinned at 6.6% and mortgage originations paralyzed by the lock-in effect, Equifax's core revenue engine will stall, and their margins will get crushed.
That was the consensus bearish narrative, and from a superficial macroeconomic perspective, it made perfect sense.
But the narrative was structurally flawed because it underestimated management's ability to pivot.
Management has unequivocally proven, with hard quarterly data, that they can not only survive, but actively expand their profit margins and grow top-line revenue at double digits without requiring a booming or even functioning housing market.
They've diversified their revenue streams and ruthlessly optimized their cost base to the point where a stalled housing sector is merely a quantifiable headwind, not an existential threat.
The operational resilience is the defining takeaway. They are utilizing aggressive structural AI integration to permanently lower their labor costs and expand margins by 120 basis points.
They are leveraging their irreplicable twin data moat to secure $300 million in sticky, recurring government contracts.
They are breaking the FICO monopoly and capturing new revenue streams with a highly disruptive VantageScore strategy.
And they are deploying their pristine free cash flow into highly accretive, strategic international acquisitions like Circulo de Credito.
So for you, the retail investor, here is the actionable framework. If you currently hold Equifax stock in your portfolio, this earnings call provides immense validation.
The company is actively establishing a solid floor under the stock price through their relentless, massive share repurchase program.
They bought back $560 million in stock in 6 months, and their $1.5 billion annual cash generation means they have the firepower to continuously buy every significant dip in the market.
You are holding a highly profitable, cash-generative asset that is actively shrinking its share count.
And if you are an investor sitting on the sidelines evaluating whether to initiate a position, the most compelling aspect of this narrative isn't actually what happened in Q2 2026.
What is it then?
It is the visibility into the 2027 growth runway. While their current execution is excellent, the true inflection point for this stock appears to be scheduled for next year, driven by a phenomenon of delayed gratification inherent in enterprise sales cycles.
Expanding on that 2027 catalyst is crucial. Think about the $100 million in brand new government contracts we discussed.
The federal OB3 mandates are active, but states take time to physically integrate APIs, train caseworkers, and fully deploy the twin data architecture.
Those massive new revenue streams will principally begin hitting Equifax's income statement in early 2027.
Consider the Circulo de Credito acquisition. That deal is scheduled to close late in the fourth quarter of this year.
Therefore, 2027 will be the first full fiscal year where Equifax recognizes that explosive 30% Mexican growth rate and begins realizing the cloud migration synergies.
Furthermore, the $150 million in AI cost savings is a run rate target mapped through 2028.
As more autonomous AI agents transition from back-office pilot programs to full-scale production over the next 18 months, those margin expansions will accelerate significantly into 2027.
And all of those fundamental catalysts, the government contracts, the M&A synergies, the AI efficiencies, operate independently of the Federal Reserve.
But we have to consider the ultimate upside scenario. What happens if inflation finally cools sustainably and the Federal Reserve begins a cycle of meaningful interest rate cuts in 2027?
That is the nuclear upside option. During the call, CFO John Gamble highlighted a staggering statistic. There are currently 15 million active mortgages in the United States, with interest rates locked in at over 6%.
15 million households currently bearing the brunt of the restrictive monetary policy.
That demographic represents a massive coiled financial spring. If macroeconomic conditions shift and mortgage rates drop back down to 5.5% or 5%, a significant portion of those 15 million homeowners are immediately going to seek refinancing to lower their monthly payments.
And when 15 million people apply for a refinance, who processes the credit checks, the employment verification, and the real-time income data for all of those new loans?
Equifax.
If the mortgage market finally unfreezes, it will act as a massive, high-margin turbocharger injected into an engine that management has already tuned to run at peak operational efficiency through AI automation and product diversification.
It is the equivalent of perfectly winterizing your house. Equifax has proven they are completely comfortable and highly profitable operating in a macroeconomic blizzard.
But when spring finally arrives and the ice thaws on the housing market, they are positioned to capture exponential upside. The structural downside is protected by cash flow and buybacks, while the upside is leveraged to both internal execution and eventual macro recovery.
It is a phenomenal demonstration of agile corporate governance and disciplined capital allocation. They recognized the macro threat early, fundamentally altered their cost structure via technology, and aggressively bought their way into adjacent growth markets.
Which leads me to a final provocative thought that extends far beyond just the financial data sector. Something I want you, the listener, to deeply consider as you evaluate the broader market landscape.
Go for it.
Throughout this deep dive, we spent a significant amount of time analyzing Equifax's $150 million in projected operational savings. We discussed how a 125-year-old credit bureau is rapidly and effectively replacing manual human labor document processing, call center interactions, and even core software engineering with autonomous AI agents.
And they are achieving this not through science fiction, but simply because they have the foresight to build a unified cloud-native data fabric.
The crucial takeaway is that the artificial intelligence isn't a speculative side project. It is actively manipulating the core operational and financial levers of a massive legacy enterprise today.
This forces us to ask a critical question regarding the current AI investment boom. Who actually wins the long-term economic race?
If you turn on any financial news network right now, all the oxygen, all the hype, and all the massive valuations are entirely consumed by the flashy technology giants. The market is obsessed with the companies designing the foundation models, the semiconductor firms selling billions of dollars of GPUs, and the massive data center operators.
The companies building the infrastructure of AI are capturing all the glory. And to be clear, they will undoubtedly generate massive revenues.
But as history has shown with major technological paradigm shifts, the most profound compounding wealth generation in the stock market over the next decade might not actually come from the companies selling the digital pickaxes.
It might come from the deeply entrenched, unglamorous legacy companies, the data brokers, the global insurance conglomerates, the massive industrial supply chains.
These are the companies that possess decades of proprietary, irreplicable data and massive bloated human labor costs. They are quietly taking these increasingly commoditized, off-the-shelf AI tools and deploying them internally to permanently eradicate their back-office overhead, perfectly optimize their logistics, and massively widen their structural profit margins.
It perfectly mirrors the Industrial Revolution. There is a profound difference between being the brilliant engineer who invents the steam engine and being the ruthless factory owner who utilizes that steam engine to fully automate their assembly line.
The inventor captures the initial glory and the patent royalties, but it is the factory owner who reaps the compounding monopolistic profit margins for the next 50 years.
What Equifax detailed in this Q2 transcript is a real-time blueprint of what the fully automated, AI-driven corporate factory of the future actually looks like.
And as we've seen today, that automated factory looks extraordinarily profitable, regardless of what the weather's doing outside. We want to thank you for joining us on this extended Talk Tickers deep dive. We completely abandoned our usual concise format, but hopefully, by taking the time to explore the deep mechanical and strategic drivers behind this earnings report, we provided you with the nuanced context required to truly understand the operational reality of this market.
Keep questioning the superficial headlines, keep digging into the raw transcripts, and most importantly, keep interrogating the fundamental data behind your investments.
We will catch you on the next deep dive.